Hello, and welcome to Hilltop Wealth Advisors Economic and Market Update for the second quarter of 2026. I'm Brittany, here today with Ben, and we're here to talk through what has been going on in the markets, plus our outlook for the coming months.
Thanks, Brittany. Our goal today really is to help you understand what may lie ahead and offer some practical investment strategies, given all the geopolitical uncertainty of this past quarter.
Yeah, it has certainly been a roller coaster start to the year. The stock market had an initial strong few months, but then we saw the market pull back in reaction to news about the U.S.-Iran conflict. However, despite this volatile news cycle, U.S. markets have bounced back as of early May. The S&P 500 recently hit new highs, driven largely by optimism that the Iran conflict will end soon, plus strong earnings from technology and AI-related companies.
Another big reason for this market resilience is that the U.S. economy is still holding up fairly well. First quarter GDP for the U.S. increased at an annual rate of 2%. Employment remains relatively stable, consumer spending has slowed but not collapsed, and corporate earnings overall have been stronger than many analysts expected earlier this year.
Yeah, that said, we have seen an uptick in inflation driven largely by the Iran conflict, particularly from the blockage of the Strait of Hormuz. Oil prices have spiked, and that immediately raised concerns about inflation, transportation costs, and global economic growth. As a result, the Federal Reserve has made it pretty clear that they are not in a rush to cut or raise interest rates in the U.S. They are much more in a wait-and-see type of mode.
As we think about the coming months, the biggest story to watch right now really is the conflict in Iran and its impact on the energy markets.
Yeah, exactly. The ongoing tensions between the United States and Iran have created really a layer of unpredictability for the markets. As we have seen, even rumors of escalation or peace talks can trigger market reactions. So, if tensions were to rise and the conflict were to escalate, we might see increased volatility. Oil prices could surge further, leading to higher costs for transportation and manufacturing, and defensive sectors like utilities and healthcare might become more attractive as investors seek stability.
In that scenario, it really is wise to review your portfolio for exposure to riskier assets and consider shifting towards more resilient industries.
However, it is likely that we could see the situation ease and diplomatic progress be made. In that case, markets could respond positively, like we saw back in April. Lower oil prices and renewed investor confidence might boost sectors like travel and retail.
And that could be an opportunity to look for growth stocks and international markets as well. Staying diversified, though, remains crucial, as positive developments can really open up new investment doors.
Absolutely. And lastly, if the situation largely remained unchanged, the market would likely continue to react to headlines and speculation. We might see brief swings, but overall the market could maintain its current trajectory.
In any of these scenarios, it's important to avoid knee-jerk reactions. Consistent long-term strategies tend to outperform short-term moves driven by uncertainty.
Now, to pivot a bit as we think longer term, another major theme continuing to drive markets is the outlook for artificial intelligence.
What's interesting here is that AI is moving beyond the hype phase and into the real economic implementation. In 2026, investors are increasingly focused on which companies are actually generating revenue and what productivity gains from it. And we're seeing AI adoption expand rapidly across a variety of industries. Companies are using AI to automate workflows, improve customer service, analyze data faster, and hopefully reduce operating costs.
We're also seeing the AI story broaden beyond just a handful of mega cap tech companies. Earlier in the cycle, performance was really concentrated in just a few big names, and now the opportunity feels more spread out.
At the same time, there are still plenty of risks. Some companies are spending enormous amounts on AI infrastructure before the long-term profitability is fully proven. And historically, whenever you have a transformative technology cycle, there are winners, but there also could be companies that get overvalued or fail to execute on that.
So one thing I know we'll be watching closely over the next several years is whether AI begins meaningfully improving productivity across the broader economy. If it does, that could help offset labor shortages, improve margins, and potentially support stronger long-term economic growth.
That's another reason why diversification continues to matter. We absolutely believe AI will be a long-term transformational force for productivity and economic growth. But we also want portfolios positioned thoughtfully rather than chasing headlines or concentrated bets.
Exactly. In our portfolios at Hilltop, we continue to maintain a broadly diversified portfolio, while we are leaning slightly into U.S. infrastructure as we think about how AI will continue to develop and be built out, as well as leaning into healthcare, which is a defensive sector that also could benefit from all of this developing technology.
As always, we recommend reviewing your portfolio regularly and maintaining a balanced allocation while focusing on your long-term goals. It's smart to stay informed, but don't let headlines dictate your investment decisions. Reach out to us if you would like to discuss your personal investment strategy.
Thank you all so much for watching. You can learn more about us at our website, hilltopwealthadvisors.com, and we'll see you next time.